All right, buckle up because this is the deep dive. And today, September 3rd, 2025, we're plunging headfirst into a pre-market landscape that's absolutely buzzing. We're seeing a mix of intriguing opportunities and some pretty significant red flags, and our mission is to cut through all that noise for you. Our goal for this deep dive is to unpack the market from every angle, from the big picture mood, the regime, down to the granular stuff on key players like SPY, Tesla, Bitcoin, and of course the VIX. We pulled together insights from a whole stack of comprehensive reports, everything from our DOTA's V2.0 analysis to the defensive posture brief and our Market 9.325 readouts. What's consistently jumping out, from all these sources is this. While we're detecting some mild bullish momentum in spots, the overarching theme, the real headline, is elevated volatility and what our systems are definitively calling a fragility regime. It really feels like the market is walking on eggshells.
It truly is. This isn't just a slightly cautious market. It's one that really demands extreme precision and a highly disciplined approach from anyone engaging with it today.
So let's unpack this a bit more then. What's the fundamental vibe of the market as we head into trading today, September 3rd? Is it clearly risk on or risk off, or maybe something way more nuanced?
Well, according to our models, we're mostly in what we call a transitional cautious risk-on regime. But, it's not unanimous. Some analyses are already leaning into transitional risk-off. The clearest signal, though, the one that's really shouting at us, is the VIX. It's currently sitting at 17.17.
Okay.
Now, that number is clearly above the critical 16.5 threshold, and that, well, that unequivocally confirms a shift to caution. It's what flags that fragility regime you just mentioned.
Right.
Think of it this way. The market's anxiety meter is definitely in the red zone. For you, the listener, this means the market is incredibly sensitive to any news, any sudden flow of capital. Defensive strategies aren't just an option today. They're frankly your primary safeguard against these kinds of exaggerated moves.
That analogy of the anxiety meter really paints a picture, doesn't it?
Yes.
And here's where it gets really interesting and honestly a bit confusing. Our sources are showing slightly different pictures for SPY pre-market. One suggests mild bullish momentum, SPY at $643.26, up from its prior close. But then others describe it as under pressure at $640.26, which is actually down from its previous close. How do we, as traders, navigate that kind of Jekyll and Hyde opening for the market anchor?
That's a fantastic question, and it really highlights just how nuanced market interpretation can be, even with supposedly precise data points.
Right.
The differing SPY pre-market prices. They show that depending on the exact timestamp of data collection, say, a reading at 6:02 a.m. Eastern versus another at 6:19 a.m., the immediate momentum can look quite different.
Like looking at clouds almost.
Exactly. One person sees a rabbit, another sees something else entirely. The critical insight here isn't which number is perfectly right in that exact moment, but that the atmospheric pressure is volatile. The consensus across all the reports is that SPY is at a critical juncture. It's coiled between firm support and strong resistance, and it's heavily influenced by these cross-asset correlations we're seeing. So regardless of the exact tick right now, the market is bracing for volatility. Understanding these different reads helps you appreciate the full spectrum of possibilities and stay agile in your own assessment as the day unfolds.
Precisely. Those tiny fluctuations are like static on the radio, but the underlying signal of volatility, that's loud and clear. Okay, now let's zoom in on the individual instruments, SPY, Tesla, and Bitcoin. What's the story for each of them today, and what are the crucial levels we need to be watching like a hawk?
Let's dive in, starting with SPY, the market anchor, as you said. Whether it's showing $640.27 or $643.26 pre-market, it's clearly grappling with critical levels. It's essentially sitting either just above or maybe right within a key support zone. We're seeing firm support identified around $635, $637. Some of our systems point to $640 as a crucial anchor point, too.
Okay, so support around $635 to $640. What about the upside?
Resistance lies at $645, $648. Now, while some models are flashing a bullish with caution signal because of those pre-market gains we saw, the prevailing sentiment across the board is more neutral defensive. There's a lean towards the downside until we see a confirmed hold above that $645 level. Think of it like a tug of war right at a major crossroads.
Got it. And then we have Tesla, which, as you know, often acts like an amplifier for the broader market. What's its story today? Is it amplifying the caution?
Definitely seems that way. Tesla is currently trading near $337, but our analysis shows pretty weak momentum. It's described as approaching a critical support down at $314. One source specifically called its current position right at the fragility cliff at $335.
The fragility cliff.
Yes.
Wow.
Yeah. And remember, Tesla's high beta nature just means it tends to magnify whatever the broader market is doing. So when there's weakness, it can really snowball. It's no surprise then that a strong bearish bias prevails with high breakdown risk below $335. The recommendation for you listening is crystal clear. Absolutely avoid new long positions until we see a definite reversal back above $340, and it needs to be confirmed with significant volume. It's a show-me situation for Tesla today, for sure.
Show me situation. I like that.
Yeah.
Okay, and finally, our digital gatekeeper, Bitcoin. How's it faring in this delicate environment? Is it correlated or doing its own thing?
Well, Bitcoin spot is consolidating. It's hanging around $111,090 to $111,417. The ETF mini is tracking around $49.18 to 41 cents. Both are firmly range bound. Imagine it like a ping pong ball just bouncing between two walls, roughly $108K to $113K for spot Bitcoin, or $47 to $50 for the ETF.
Stuck in the middle.
Pretty much. We haven't seen any confirmed breakout in either direction yet, so this gives us a neutral bias. The focus right now is more on range trading rather than making big directional bets.
Okay, so if we connect this back to the bigger picture, it really sounds like these assets aren't just moving independently. You mentioned cross-asset convergence earlier. What does that actually mean for our portfolios today?
It's so vital to see how these individual stories don't happen in a vacuum. The moment we talk about specific levels for SPY or Tesla, we have to remember this deep interconnectedness. Cross-asset convergence means high correlations. We're seeing it strongly between SPY and Tesla, and also Bitcoin and SPY. So weakness in one can genuinely trigger a risk cascade potential across your whole portfolio, like dominoes falling.
Ouch.
Yeah, and this can severely reduce your diversification benefits, especially during periods of market stress like this. So for your portfolio today, these specific price levels and behavioral patterns, they aren't just data points. They're essentially your roadmap for anticipating potential moves and, crucially, for protecting your positions.
That makes a lot of sense. So with this delicate balance in mind, what's the game plan? How do we translate these observations into actual actionable strategies, especially when the market's in this fragile state?
Right, strategy time. But given the fragility, any opportunity needs to be approached with extreme caution. For SPY, you could consider SPY $635 put spreads with a September 6th expiration, but only if a bounce attempt above $642 clearly fails.
And just quickly for those listening, a put spread limits your risk while betting on a moderate down move, right?
Exactly. It's a defined risk strategy. And interestingly, our ESPRE system, that's our edge spotting and predictive risk engine, has even identified these specific puts as potentially undervalued.
Oh.
That suggests the market might be underestimating the downside potential, giving us a bit of a strategic edge if we're prepared for that scenario.
That's a great insight into the why behind the trade. And for Tesla, which you said has that strong bearish bias.
For Tesla, the TSLA $330 put for September 6th is highlighted as a primary edge.
Yeah.
Isigiri also deems this one potentially undervalued.
Yeah.
Entry trigger. That would be if Tesla breaks below $334, and importantly, with volume. And again, that strong reminder. Avoid new long positions until you see a clear reversal above $340 confirmed. No jumping the gun.
Okay, makes sense. And for Bitcoin, still stuck in that range, what's the play there?
Yeah, Bitcoin being range-bound actually presents a different kind of opportunity, an iron condor strategy.
Ah, collecting premium.
Precisely. For those unfamiliar, an iron condor is like setting up a profit fence around the current price. You profit as long as Bitcoin stays within that fence, essentially collecting premium from the market's elevated volatility. We'd be looking at the 110K or 113K spot range, or maybe the $47, $50 ETF range. But, and this is critical, with absolutely tight stops in place to manage the risk if the range breaks.
So mostly defensive or range-bound plays. Are there any opportunities for calls even in this environment? Or is that just too risky?
Very, very cautiously. SPY 643C, 645C corals calls for September 12th expiration are flagged as potentially opportunistic. But, and this is a big but, only if SPY sustains a hold above $643 with significant volume. We're talking greater than 6 million shares in the first hour.
That 6 million share threshold.
Well,
Why that number specifically?
it's often seen as sort of an institutional tell. It's a rough gauge, but it suggests the minimum volume needed to confirm that big money is truly committing to a direction, not just, retail noise or head fakes.
Got it. So that's a lot of tactical plays, all with careful conditions. But what about the mandatory stuff, the hedges? Especially with the VIX this high, what's our portfolio insurance policy today?
Absolutely crucial, can't stress this enough. For hedges, VIX $18-20 calls with an October expiration or UVXY $16 calls for September 13th are pretty much mandatory considerations for today.
Okay, and how do we know when to pull the trigger on those?
Good question. The entry trigger for the VIX calls is seeing the VIX sustained above 17.5 for 2 or more hours. It needs persistence. For UVXY, it's a scaled entry. You might start with a small, say, 0.25% allocation if VIX hits 16.5, then maybe scale up to 0.50% if VIX reaches 20. This isn't about hitting a home run. This is your essential portfolio insurance against a full regime shift into risk off.
It's a really smart way to think about it, insurance, not just speculation. And speaking of how options behave, you often talk about convexity. Can you quickly unpack that for us? Why is it important for understanding the VIX and Tesla plays?
Yeah, convexity is a fascinating concept. It basically helps us understand how sensitive options prices are to the underlying assets' movements. Think of it like a spring. The VIX has the highest convexity score in our analysis right now, a 7.5 out of 10. This means its options prices tend to jump disproportionately higher when volatility spikes. It's like that spring coiling tighter and tighter, ready to explode upwards.
So the hedges pack more punch.
Exactly. These VIX hedges are a clear priority because they can give you a lot of bang for your buck when the market gets truly rattled. Now, Tesla, even with its high beta, actually has a lower convexity score, around 4.1 out of 10. Its options still move, of course, but not with that same kind of explosive force relative to its own extreme risk profile, which reinforces why avoiding new long positions is the critical move there, rather than just betting on option sensitivity alone.
That makes sense. So given this delicate balance, the fragility, the potential for explosive moves, what are the rigorous risk management protocols we should all be tattooing on our brains today? These aren't just suggestions, right?
You're absolutely right. These are non-negotiable rules for today. In this fragility regime, your number one goal isn't chasing every last tick of profit, it's protecting your capital. Think of it like a poker game where everyone's on edge, you want to play tight, preserve your stack, and only make big bets when the odds are overwhelmingly in your favor.
So practically speaking,
First, reduced position sizing is paramount. We strongly recommend reducing all high beta and tech exposures by maybe 30–40% from your normal allocation size. Keep individual position limits capped at 3% of your capital, and total options exposure should not exceed 25% of the portfolio maximum. This is purely about not getting overexposed when things are this jumpy.
okay, smaller bets. What else?
Second, tighten your stops. Strict stop loss levels are absolutely critical. SPY below $635, BTC spot below 108K, Tesla below $310. Think of your stop loss today like the emergency brake in your car. You hope you never need it, but when you do, it needs to work perfectly and you have to pull it.
No hesitation.
Zero hesitation. Hesitation in a sensitive market like this is often the most expensive mistake a trader could make. These are your kill switch triggers.
Okay.
Third, limit your 0 DTE exposure. Those 0 days to expiration options, they expire today. They can move incredibly fast and are inherently very risky. Cap these at a maximum of 1% of capital per trade and keep your total daily 0 DTE exposure under 3%. And definitely avoid initiating these trades after 3:00 p.m. Eastern. The risk reward just gets skewed badly then.
Good reminder. And finally,
Be aware of critical timing. There's a Fed Audi speech window scheduled from 11:00 a.m. to 11:50 a.m. Eastern Time today. Our recommendation is to flatten all positions, get out of the way during this period. The event risk is just too high. This isn't the time to gamble. It's a temporary pause button. These strict protocols are really your essential toolkit for protecting your assets today.
okay, let's bring this all together then. Your actionable pre-market playbook. What are the key execution reminders before that opening bell rings?
It absolutely boils down to discipline and awareness today. First, volume confirmation is essential. All those entry triggers we talked about, they require the specified volume thresholds. No exceptions. Don't chase price without volume.
Got it. Volume first.
Second, strict stop-loss discipline. Stick to your hard stops. Emotional overrides. Trying to hope your way out of a losing trade. That can lead to really significant losses very quickly today. Third, always maintain that acute awareness of this fragile market environment. The VIX being above 17 demands a defensive mindset even when you see those tactical opportunities pop up.
Stay offensive.
Fourth, stay liquid. Keep a higher cash allocation than usual. This gives you flexibility both for seizing real opportunities and for playing defense if needed. And finally, monitor constantly, especially the open initial session, say 9:30 to 11:000 Eastern. The first 30 to 60 minutes are absolutely critical for validating the setups we discussed. Keep a close eye on SPY's movement in that 643, 645 range. How it behaves there will heavily dictate whether call or put strategies gain an edge early on.
It's genuinely powerful, isn't it? Seeing all these different sophisticated systems, Dota's V 2.0, Ultimate Analysis, Edge Nexus, essentially whispering the same core message. It feels like a universal truth for this kind of market condition.
It is reassuring, definitely. That cross-system alignment we're seeing today tells us the core principles converge. Take smaller sizes, scalp ranges carefully if appropriate, and keep those hedges ready to go. This consensus really underscores the cautious, disciplined approach we're advocating for you today.
Okay, so to give you a concrete pre-bill action plan, before you even think about clicking a button today.
Right. Here's the checklist. 1 SPY. Watch that 643.3, $645 open like a hawk. Your contract choice call or put should align with either a clear breakout above or a confirmed rejection below this zone with volume.
Okay.
2. TSLA. A sustained drop below $334, again with volume, should be considered your put entry zone. Otherwise, staying flat, just watching from the sidelines, is probably the prudent move.
Patience on Tesla unless it breaks down.
Yeah. Exactly. 3. BTC. Remain neutral. Wait until the ETF mini sustains either above $49.05 for calls or dips below $48.05 for puts. Don't get chopped up in the middle.
Let the range break first.
Let it show its hand. And 4. Hedges. Keep your UVXY or VIX calls queued up, ready to deploy the moment VIX sustains above that 17.5 level. Be prepared, not reactive.
Discipline and preparedness. It sounds like those are truly your greatest assets in navigating a delicate market like the one we're seeing today. It's really about protecting your capital first and foremost.
Always. Capital preservation is the absolute golden rule, especially on days like this.
So to wrap up, today we've navigated the really intricate landscape of September 3rd's pre-market. We've identified the delicate balance of this fragility regime. We've dissected the critical levels and biases for SPY, Tesla, and Bitcoin, and maybe most importantly, laid out a defensive yet opportunistic playbook. The priority, above all else, is capital preservation through that strict risk management and active hedging.
Absolutely. And maybe a final thought to leave you with. In a market that's constantly shifting between these moments of risk-on confidence and sudden risk-off caution, and with these kinds of insights and tools at your disposal, what new behavioral patterns or subtle indicators will you discover today? What might become your next early warning system, helping you guide yourself through this volatility?
That's a great question. Keep learning, keep watching, and most importantly, keep questioning. The market, as they say, reveals its secrets to those who observe with discipline.